Last time you spoke to Bloomberg Television, I think was in Davos, you spoke to my colleague Eric Schatzke. You said that you hadn't felt so good since 2007, and that was a worry. And then things changed a little in February, didn't they? You were prescient then. How do you feel this morning then, Jean?
Well, in a way, I hate to have been prescient, but I think it was a good thing, because at the beginning of the year we had a fair bit of euphoria on the back of the fiscal stimulus in the United States and just a feeling that Europe was on the verge of an upswing in the cycle. I think today we have probably a more balanced view of the markets. I think people who want to be positive see strong economic growth around the world, synchronized economic growth, and they see rising earnings growth. So rising earnings. So people who want to be positive continue to be so. People who want to be negative, they see the fear of rising rates, notably in Europe, continued rising rates in the US, elevated valuations. I'm not saying they're irrational, but they're elevated, no doubt, and probably a fear of inflation. So we've got a more balanced debate today.
A balanced debate. Do you fear rising interest rates? Are interest rates going up for the right, quote-unquote, reasons, or is this something that you worry about?
Well, we all want to believe that at some point in time there will be normalization of monetary policy. It has started a couple of years ago in the US, and it's progressing. In Europe, I think the debate is how and when will the ECB really be able to normalize its monetary policy? It has announced it would stop quantitative easing by the end of the year and then start rising rates in 2019. It will take time, and there's a fair amount of debate as to what will the ECB actually be able to do, given that there is no sign of the target inflation yet percolating in the data.
So with that as the backdrop, let's talk a bit about how you run your business, how your business should be managed. Consolidation in the European asset management space is a big theme, and you've talked about your business being a natural consolidator. Update us on your plans for consolidation.
Well, we continue to be having many dialogues. I would say that a number of our colleagues in the asset management space do fear that at a certain point in time they hit a glass ceiling, be they at 2 billion, 20 billion, or 200 billion of assets under management. Our business model, the multi-boutique business model with centralized distribution, does provide an answer to these challenges, but we want to be careful and quite sensible about the way we allocate our capital.
So you could save them from their glass ceiling, but what does it do for Natixis? What's the benefit? What are you looking for in terms of bolt-on acquisitions?
We're trying to expand the scope of our strategies, be it notably in the alternative space, which continues to be in high demand from clients. We want to expand also in the Asia-Pacific region. We also want to be mindful of strategies where we've got capacity issues. We are at the heart an active asset manager, and one of the most important things to preserve our brand and reputation is to be mindful of capacity. And what we do here is actually when we have an important strategy that reaches capacity, we try to see if other parts of the group can fulfill that need of clients. And that is the beauty of having our broad array of affiliates. We can actually do that. But in some cases, we have holes that we want to plug, and external growth would be a way to do that.
And if you want to plug those holes, will you maybe need a little bit more money to do it? People are asking whether you might decide to list the asset management unit of the business, to raise a bit more money, to do some of that M&A.
Well, we have a very supportive shareholder. As you know, we're part of the BPCE group, the second largest banking group in France. Very supportive, significant tier 1 ratio, so very strong financially. And for the time being, we have the support of our shareholder, and there's absolutely no talk of listing the business.
So no talk of listing, no need to go elsewhere to get any money?
For the time being, we have a very supportive shareholder, and that's all that counts.
That's all that counts. Talk to me a little bit about MiFID II. We saw the implementation of MiFID at the start of this year. It came into force. What has the cost been like for Natixis? Is this something that you've breezed through, or is it something that's caused you headaches?
Well, of course, we've had to adapt. We've had to invest in our systems. Of course, the debate has been also on the cost of research. I would say that on the latter point, what's interesting is that once you start having people pay for it, you start to be a lot more discriminatory into what you buy and what you don't buy. And I think that has been healthy for the business. So, in fact, there may be some upfront costs, but I think further down the road, there'll be savings.
And I know you're perhaps in a closed period, can't talk too much about the business, but in terms of how the business navigates the highs and lows of the markets, the sell-off we saw in February, and the more recent performance, anything you can update us in terms of the inflows environment?
Well, we are our biggest risk is the market. So, of course, we had a very strong beginning of the year, more volatile in the last couple of months. But of course, our business remains strong, and we have, I think, right now an environment which is very conducive to active asset management, and that's what we're focusing on.
Okay, Jean, thank you very much for your time. Good to speak to you this morning here in London. Jean Raby joining us there from Natixis.